global markets while on the move or even when I'm sleeping. I was one of those who were clueless about trading, but today it's all at my fingertips, 24/7. And I mean literally. Here I trade in equities and futures at ease, and most importantly, at real-time prices. Everything you see here is live. And there's also Live Alert allow me to take action when the price is right for me on the Bursa listed stocks. When it comes to a trading platform, you really want one that is convenient and what works best for you, preferably one that offers better trading opportunities. When you see a good trading potential but you lack funds to trade, no problem. You have access to additional financing. The secret to being a good trader is not a secret at all. Once you have found the right trading platform, equip yourself to make informed decisions. Only the right trading partner will make sure of this. I truly appreciate the daily current updates by trading research analysts on the RHB Morning Cuppa at 8. It keeps me informed and up to date. With RHB Investment Bank, it doesn't matter what trading experience or strategy you have, your individual needs will be met. They are committed to you. And because of that, they are available for you anytime, anywhere, even when Malaysia is asleep and trading is active on the other side of the world. This multiple award-winning service is the right fit for any trader. It's even more rewarding when you can collect loyalty points for great rewards every time you trade. Nothing is more worthwhile than this. What are you waiting for? Download the app and start trading.
Waran terstruktur seperti gerigi yang ditambahkan daya ungkit, akan membuatnya bergerak seirama dengan saham dasarnya. Matriks waran membantu investor dalam menghitung kemana harga waran akan bergerak ketika saham dasarnya bergerak. Silakan kunjungi website kami untuk melihat matriks waran. Matriks ini memudahkan investor untuk mengetahui harga WT tanpa harus melakukan perhitungan sendiri. Kontak kami di sini, sebut kami Dr. Waran.
Some people find trading stressful, but not me. Hi, I'm Shafiq. I'm a vlogger and trader, and today I'm sharing my best kept trading secret with you. I trade in local and global markets while on the move or even when I'm sleeping. I was one of those who were clueless about trading, but today it's all at my fingertips, 24/7. And I mean literally. Here, I trade in equities and futures at ease, and most importantly, at real-time prices. Everything you see here is live. And there's also Live Alert allows me to take action when the price is right for me on the Bursa-listed stocks. When it comes to a trading platform, you really want one that is convenient and what works best for you, preferably one that offers better trading opportunities. When you see a good trading potential but you lack funds to trade, no problem. You have access to additional financing. The secret to being a good trader is not a secret at all. Once you have found the right trading platform, equip yourself to make informed decisions. Only the right trading partner will make sure of this. I truly appreciate the daily current updates by trading research analysts on the RHB Morning Cuppa at 8. It keeps me informed and up to date. With RHB Investment Bank, it doesn't matter what trading experience or strategy you have. Your individual needs will be met. They are committed to you. And because of that, they are available for you anytime, anywhere, even when Malaysia is asleep and trading is active on the other side of the world. This multiple award-winning service is the right fit for any trader. It's even more rewarding when you can collect loyalty points for great rewards every time you trade. Nothing is more worthwhile than this. What are you waiting for? Download the app and start trading.
Good afternoon, ladies and gentlemen, and welcome to this highly anticipated webinar titled China, Bear Market, Economy and Market Ahead. Main beneficiaries, India, China, Japan, and Singapore consumers. I'm Alan Lau, and it's a pleasure to be your host for today's insightful discussion. The question is China's bear market a concern? That's the question we are here to address today. We will explore the intricacies of China's economy, its impact on the global landscape, and identify the main beneficiaries, including India, Japan, and Singapore consumers. Leading the way in our discussion today is our distinguished speaker, a renowned authority in the field of economics. Please join me in extending a warm welcome to Dr. Sailesh K, Group Chief Economist and Head of Market Research at RHB Banking Group. Assisting us today, we have a distinguished panel of moderators who will help facilitate our discussion and ensure that we gain the most from this webinar. Please join me also to welcome Pak Berlian and also Pak Wafi from RHB Sekuritas Indonesia and Mr. Tanakat from RHB Securities Thailand. Okay, we are streaming this webinar live to our clients and counterparts at RHB Thailand, Indonesia, Vietnam, and Cambodia. So a big welcome to all of you that's joining us from all the other regions. Recordings of this webinar will be made available on our Facebook group, RHB Morning Cuppa at 8. Towards the end, we'll open the floor for questions from each region. Then we will address it to Dr. Sailesh for his answers. So before we hear from Dr. Sailesh, please allow me to share some specials exclusively for you today. Firstly, enjoy expanded zero brokerage from us. Open an account now with RHB Investment Client Now mobile app and to get CDS fee waivers and enjoy zero brokerage for all online equities, local and foreign buying up to 1,000 ringgit for 60 calendar days. campaign will run until 31st of December 2023. Next up is our latest campaign from RHB Investment Bank called Electrify Your Trades Campaign 2023. This will run from this has been running from 1st of February and it will go on until 31st of December 2023. You will get a chance to win 236 amazing prizes worth 250,000 ringgit, including the main prize, which is a brand new Mini Cooper SE electric vehicle and 235 other types of vouchers. So the more you trade, the higher your chance to win more prizes. Lastly, our exclusive morning kappa at 8 Facebook group is now open for the general public as part of RHB's initiative to increase public interest and literacy on making informed investment decisions. So please scan the QR code that you see on the screen right now to get your access. All right. So without further delay, I invite Dr. Sailesh Jha to take the virtual stage and kickstart our enlightening discussion for today. Doctor, over to you.
Hi, Ellen. Thank you all for attending our presentation. Let me just share my screen. Okay. Can you see the screen, Alan?
Yep.
Does it look okay?
Yeah, I saw the bear.
I saw the bear. Yeah. Okay, that's the main point. So, all right. So let's basically summarize, where we've come from over the last couple of weeks to start with, and what does the future look like, as well as the overnight developments that have transpired regarding the Fed, and what we think then the implications for financial markets are. So there's a lot of things to talk about. So recently, the three main themes driving markets have been the outlook on the Fed, how high are they going to go in terms of the Fed funds rate, and when are they going to start cutting the federal funds rate. Market has been pricing for quite some time, cuts starting in the first half of next year, and a peak rate of around 5.3%. Our core view remains unchanged. The Fed is going to remain higher for longer. The peak Fed funds rate in our forecast for quite some time has been 5.5 to 5.75% versus current 5.25 to 5.5%. And the balance of risk is tilted towards the Fed going even higher than 5.5 to 5.75%, potentially to 5.75 to 6% at the peak rate. And we have basically all along stated to clients that we don't expect any federal funds rate cuts in the first half of the year, and there could be some modest cuts in the second half of next year. That's the first thing to focus on as far as markets go. The second theme that has been driving markets has been China. So we've been China bears, all the way since December 15, 2022, when we had indicated in our 2023 outlook to sell China and essentially buy India in terms of stock markets. And that, our current thinking is that the Chinese stock market, as far as the MSCI China goes, it's going to get you basically negative return of 20%. We're already around 10% down, and India is starting to perform now. And that our favorite market in the world remains the US stock market. And thirdly, in terms of global asset allocation for the better part of this year, most big investors, people that I know and people that I don't know, mostly the positioning has been at a global level, has been overweight cash, overweight fixed income, market weight cash, and underweight equities. That asset allocation at a global level really hasn't worked, and most global asset managers have been long emerging market on the back of a China recovery view and outperformance of Chinese equity market and shorts developed markets positioning. And that has turned out to be very challenged and actually quite wrong, right? And we've been all along long DM, short EM because of our bearish view on China's market. So it's always good to take stock. If you have controversial views like we have had, how have we really done, right? Talk is cheap, as I always say to Wafi and Tanapat and Alan. We can talk a big game, but if it's not working out, too bad for you, right? So why should I listen to you? So here we have on slide number 5, the total returns chart. Alan, you can see the total returns chart? Okay.
Yep.
Okay, great. So look how we have done. Our controversial counter consensus view of buying the US on any dips for the whole of this year has worked so nicely. So the NASDAQ, for example, we're at 29%, S&P 500 around 14%, we've been long Japan also, a bit late to that trade, to be very honest with you. We went long Japan in April when a big part of the move had happened. But, nevertheless, MSCI Japan has done also fairly well, 13.6%. And when you look at other countries that we like, MSCI India, not too shabby. These are all in dollar-based returns. It's not in local currency. So it's 9% on MSCI India, where we have been quite positive. And also, I'm sure Wafi will be happy to hear this. We have been long on Indonesia since I went to Indonesia in the month of June. And we turned positive, and the MSCI Indonesia is about 4%. So not too shabby, not too shabby. And when we look at China, it's given you total returns of like close to negative 9.1% as of yesterday close. And we think basically there's 10% more downside. What that means is if you continue to be long China, first, you already made loss. Second, that you're going to make even more loss if you stay in that trade, particularly if you're looking at MSCI China as the benchmark, 10% more downside risk. So 20% bear market in China is what the market will look like by the year end. So keep in mind, we're at September 21. So it sounds a little bit crazy that by the end of this year, you could get another 10% downside in MSCI China. But basically, the problem in China is that the market, most global investors still long China, positioning heavy. They're starting to essentially lighten up, but it's not light enough. And in India, on the opposite side, the positioning is quite low, right? And this is several years of the trade that hasn't worked on the part of global investors of being long China, short India, right? That hasn't worked. And so then you look at, okay, this is a great story for equities. So how have bonds performed, right? So you look at, like the U.S. 10-year bonds. Where are we? This is very small. Basically not giving you anything. We have gotten -2 returns, and essentially all other bonds have not done very well, right? So these fixed income guys who have been going around the world pitching B bond bulls, equity is bad, we're going to get a correction. 10% correction, 20% correction hasn't happened. So that's the problem now, is that a lot of investors are like so bullish on bonds, the trade that hasn't worked, with basically US 10-year yields, which are now closing in on our short-term forecast of 4.2 to 4.5% range. We were at around 4.4% overnight. We've got more pain to go in bonds because we think by the year end, US 10-year yields are going to go to 4.5 to 5%, right? So bottom line is, if you haven't invested in equities yet, you still have opportunities, and those opportunities are in the US, in India, and Indonesia, to name a few. And of course, we continue like Japan and Korea and Singapore. So now that we've gone through the forward-looking views, let's talk about a little bit more detail in terms of China, right? Since this presentation is related to China. How do we trade? If we're bearish on China, what do we do? right? And what are the reasons for our continuous bearishness on Chinese economy and Chinese markets is that, the China GDP this year is going to print 4%, next year maybe around 4.5%, right? Fairly weak growth. That is the official, officially what China GDP will print. What the actual is, meaning that the China data is usually fudged by the authorities in China. And statistically, what we have computed from a bottoms-up perspective, looking at all the micro-level indicators and trying to tally it with the GDP numbers from top-down, is the numbers on GDP have historically and also currently are overstated by 150 basis points. So Chinese economy this year will actually grow 2.5%. And last year, the Chinese economy grew officially at 3%, but they grew on an actual basis 1.5%. Next year, if they print 4.5%, they're actually 3%. That's recession in China, because the subsistence level of growth in China, I've mentioned to all of you many times, it's like a broken record, is just to feed the population and to ensure that social unrest doesn't pick up. The Chinese economy needs to grow at an actual basis of minimum 3%. So we're at that borderline where basically the people are most likely already going hungry, as you can see from consumer spending dropping and social unrest picking up, which all the evidence is there on the online media, maybe not in the print media, but you can see that social unrest in China is picking up. So what that means is that the trade, which a lot of people were thinking about, of a V-shaped recovery in Chinese equity market is not going to happen. And I'll show you a couple of charts on that the market over there, both the equity market and bond market, trades on the momentum of GDP growth, means that the MSCI China, from just a capital returns perspective, will decline by 20% by the end of this year. That also means that the currency is going to weaken further. Okay, we've been basically CNH bears. And that's one of the reasons we have been ringgit bears. So our asset allocation just for currency space has been overweight Singapore dollar, market weight IDR and Thai baht, and underweight CNH and ringgit. So why we're underweight CNH is dollar CNH, we think by the year end will print 730 to 740. By the end of this month, we had a target range of 725, 735. It's in that range, going to close the month at the upper end of that range of 725 to 735. But the more problematic issue is that in the medium term, I guess medium term defining over the next 1 to 2 years, dollar China balance of risk is tilted that it could hit essentially 7.5 to 8. So where is the currency appreciation story in Asia? You got none. Okay, Asian currencies from a balance of risk perspective over the next 1 to 2 years, most likely going to be under pressure to depreciate against the dollar. So the idea is that you want to be careful when you are picking equity markets in this part of the world to invest. Like I said, the safest trade really is to invest in the US equity market in the sea of red. That red is going to continue over the next 1 to 2 years. Play it safe. That's it. Just basically think about, looking at a U.S. equity mutual fund or U.S. equity ETF. That's it. Keep it simple, right? Because the situation globally is not going to change anytime soon, because the top-down view, although we are not, if you go to bullet point number 1 on slide 2, you will see that, yes, we're positive on global growth, a reacceleration in the second half of the year into next year, no recession coming in the U.S. And in major developed economies this year or next year, something we have had of this view in place in summer of last year. The problem then becomes that if growth is reaccelerating in the second half of this year globally, it means that our view, which we put out in July, of rebounding oil prices and food prices and commodity prices, broadly speaking, means that demand side pressure and supply side pressure, inflation is going to go up. It's only going to go up. So we are not in the camp of like Goldilocks, that inflation is going to come down miraculously and all is good, that we're going to go back to pre-COVID types of inflation rates. That's not going to happen. So the bottom line is be prepared for higher for longer inflation, and that means higher for longer inflation in many parts of the world, including in Southeast Asia. So if you look at then, weak Chinese economy, how do we play it? Slide number 3, the main, some of the things that have been drivers of growth here in this part of the world have been consumer spending. So, the places, consumer spending is one area which will get affected by a weak Chinese economy, trade and foreign direct investment, interest rate channel in some countries, and some global geopolitical events, mainly in our perspective, given the dynamics of what the Middle East and Russia has done in terms of supply restraints on oil, is essentially watch basically those geopolitical events related more to oil rather than the typical thesis of Russia-Ukraine. So here we are, conclusion, in summary, the vulnerabilities to Chinese economy in terms of the consumer, okay? So, places where we are really concerned about the consumer is Malaysia and Thailand. Okay, Malaysia, because consumers now, even though labor markets are strong here in Malaysia, problem is that people are worried about the currency. So we've had a controversial view throughout the last couple of months, taken a lot of heat on it, that by year end, dollar ringgit will be at 470 to 480. By the end of this month, where our forecast is 465, 475, probably more towards the midpoint of the range, around 470. And further out in the future, maybe by the end of next year, we're still at a high level, 450, 470. So consumers here in Malaysia, super worried that currency depreciation pressure, it will remain intact for quite some time. Inflation will go up, erode real incomes, and basically stock market not doing anything. We've been in terms of Malaysia, asset allocation have been overweight equity, overweight fixed income, market rate cash, and underweight equities. The equity market has gone nowhere. It's basically, if you look at here in Malaysia, you will see that the total returns in Malaysian stock market, MSCI Malaysia, one of the worst performing stock markets in the world, 10%. So if you're involved in Malaysian stock market, you have to be underweight from an asset allocation perspective. Invest those funds elsewhere in the world, like the US, India, Indonesia, Japan, Korea, to name a few. Thailand is not a currency story. Thailand is more of our view of weak tourism. Okay, so and the weak tourism is mainly due to we don't expect the consensus view to materialize, where China economy reopening, the Chinese tourists are going to come back in full force and come to our countries and buy a lot of stuff. That's not going to happen. So that's why we are basically in terms of the Thai consumer, quite concerned, more related with the tourism channel, and some of the political risk premium, which is still there, not mainly a currency story. Yeah, where we're quite positive on the consumer is India, Japan, and Singapore. So India is not really affected much by Chinese economy or Chinese markets, mainly domestically oriented. Stock market looks fine. Currency, yes, depreciation pressure, mainly due to interest rate differential in the U.S., but Indian consumer not bothered about their currency much, because they're essentially, more domestically driven in terms of their psychology to spend. Japan's doing real well, stock market doing well. And in fact, a weaker yen against the dollar is good for basically Japan, because it leads to stronger exports, and which creates jobs, which creates income, good for the Japanese consumer. Singapore, the currency isn't much related in terms of correlations with dollar China, simply because it's got strong fundamentals in terms of the balance and payment situation. Flight to safety country, people like to invest in Singapore in a variety of manners, whether it's the property market or the stock market. So the Singapore consumer we're relatively optimistic on. Indonesia, South Korea, basically no man's land. Yeah, Indonesia does get affected by currency pressures, but not as bad as places like Malaysia and Thailand. And South Korea, it is impacted by the dynamics of Chinese stock market, Chinese markets, and Chinese economy. Got quite a bit of exports, vertical supply chain linkage with China. So those impact on export-oriented sectors in Southeast Korea doesn't lead us to think they will outperform the region, nor do we think they're going to be as bad or worse off as Malaysia and Thailand in this part of the world. So that's, if you're thinking about consumption as a theme to play the stock market, we would say India, from a balance of risk perspective, India, Japan, Singapore are the places to play that consumer theme from a financial markets perspective. When we look at the technical picture, let me just show you in high frequency, slide number 6. We have the Shanghai Composite Index, which is what we look at in this part of the world, right? In terms of high frequency traders, that's what they look at. Not really the MSCI China per se. That's more for guys sitting out in London, New York. But basically, the picture don't look good. Basically, it's a stairway down, right? I'm not going to use the H word this time because I think Alan will get pissed off at me. But essentially, it's a stairway down, okay? Not the stairway to heaven, the old Led Zeppelin song. Okay, dollar CNH, we're trading around 730 and change right now. It's headed to higher level, 733. By the year end, we're at basically 730, 740. This currency, dollar CNH is headed north. Balance of risk, 7.5 to 8 is coming. All right. Some of our forecasts, let's see here. What can I show you which is so startling? Okay, so slide number 9. Given that we've just had the Fed meeting, so let's talk a little bit about the Fed. In terms of our key conclusions on the Fed. Bottom line is that we're at currently at 5.5 to 5.75% peak rate with a balance of risk at 5.75 to 6% peak rate. And, our forecast that we're penciled in 4.25 to 4.5%, kind of like, I think it's similar to what the Fed has penciled in, roughly, the upper end in 2024. Fed funds, Fed projections right now are at around the 5%, right? So we're a bit lower than that, but on back of today or overnight forecast release by the Fed, these numbers are now looking a little bit too low. They're much higher than the consensus, but I think that it's quite possible the balance of risk is quite skewed towards the Fed remaining at 5% for a prolonged period of time. So what that means is that any sort of cuts, which we think will happen in the second half of next year, is going to be very, very modest. In other parts of Asia ex Japan, we're mostly on hold in terms of the policy interest rate. Indonesia looking a little bit peculiar, but I would just say that the balance of risk to that cuts forecast in Indonesia is tilted to the upside. I don't think that at this stage that our forecast of 5.25% policy interest rates is achievable. It's probably going to be higher than that level. On the currency forecast, we really haven't made many changes in our forecast since July. Where we have made changes are on our forecast for dollar yen, where we were previously for the third quarter and fourth quarter at 142, 145. Clearly, that has surprised us on our upside. We're at 145, 150. Next year, a bit lower, 135, 140. But the main thing to focus on as far as Asian currencies goes is watch the dynamics of dollar China. That's what's driving the rest of currencies in Asia ex Japan. Not dollar yen, not euro dollar, not the big dollar index. That's not the case, right? So as I said, the places where we're most bearish in the currency world are CNH and ringgit, and we are neutral on Singapore. We're neutral on Thai baht and Indonesian rupiah, and we are basically overweight on Singapore dollar in the currency world, right? In terms of our bond yield forecast, right now the 2024 outlook a little bit sketchy from our side. I think basically what we have placed in for the averages for 2024 for the U.S. in particular are a little bit on the low side. So the balance of risk to our forecast right now are tilted to the upside for U.S. 10-year bond yields. Some charts that I'd like to show you. So questions always arise if you have a weak forecast for China. Does that mean that the rest of the world is going to suffer? And the answer is no. Slide number 13 clearly shows you that, U.S. and Japan are doing just fine in terms of GDP momentum until the second quarter of the year and are kind of disentangled from the foreign China growth picture. And in rest of Asia, Singapore, Indonesia, South Korea, growth is looking pretty all right, well, despite a weaker China. So what this two charts suggest to you is that all we need is a robust U.S. economy growing at trend around 2.5% to offset the effect of a Chinese economy, which is growing at 4 to 4.5% over the next 12 to 18 months. Okay. On inflation, as I mentioned earlier, we're in the camp that we're not going to get essentially a Goldilocks or soft landing in inflation. Inflation is going to turn and reaccelerate in the second half of the year into first half of next year as oil prices go up. So you've seen Brent oil price in the blue line, left-hand side chart, left-hand side scale is going up. And basically, we do think that things like food and metal prices will follow suit. Oil is going up, where we think the balance of risk is that we're going to break through $100 quite easily in the next couple of weeks. Okay, by the year end, we're going to be easily above $100 Brent oil. And that's partially due to, of course, the Saudis and Russians curtailing supply, but also global industrial production on the right-hand side blue line is starting to form a bottom. And we think that with that acceleration on global industrial production, the demand side for to support higher oil prices is going to kick in, as well as the supply side effect that from Saudis and Russians. When you look at where we are in the global growth picture, we already starting to see acceleration because monetary conditions, global money supply is loosening. So the Fed is worried about this left-hand side chart, where global money supply is starting to rebound, and that's the reason why they need to go to higher levels of interest rates in terms of policy interest rates than they are seeing currently. When you look at the markets in China, if you look at the consumer in China, right-hand side, that Chinese consumer is impacted by the momentum of the Shanghai A-shares index, that's the domestic stock market index, positively related. And if the currency is going to weaken further, meaning dollar China goes up, the MSCI China essentially goes down. That's what the left-hand side chart indicates. And MSCI China also trades with China GDP growth. So as growth starts to weaken, MSCI China comes down, left-hand side chart, and even the high-yield bond index trades with China GDP. So weaker growth leads to weaker bond market in China as well. The picture for the Chinese consumer, slide 23, is weak because essentially we have seen a little bit of acceleration in real disposable income on the left-hand side chart, but not much. Consumer is spending in China is driven by real urban disposable income, and the recovery is fairly weak. That matters for people who are interested in the tourism outlook, all right? And what does the tourism outlook suggest in China? You will see on the right-hand side, slide 28, that the traffic at China's airports is on the decline. It's well below trend. So that idea that the Chinese tourists would come back in a big way to our part of the world and the rest of Asia is not going to happen. All right. So if you are basically, from a financial markets perspective, playing the tourism theme, and that tourism theme is backed up by your view that the Chinese tourist is going to come back, it's not going to happen for you. The tourism essentially momentum in this part of the world is going to be driven more by India, Southeast Asia, and the Western world, not by China. So that's where we'd like to show you some charts. On the slide 30, you notice that the tourism arrivals in Japan, South Korea looking very good, and similarly in Singapore. So if you're playing the tourism theme from a financial markets perspective, maybe the stock market perspective, you are looking at Japan, Korea, and Singapore. Those are the places to be, I would think, right? So I'll stop there because we are into half an hour already and like to open up the floor to questions. But the bottom line in terms of the summary of what to do with our bearish view on China from a stock market perspective is to play safe. Top idea is to buy US equities on dips, followed by India, Indonesia, Korea, and Japan. For those of you which have exposure to basically dollars, like you're sending your children overseas for schooling, wherever it may be in the world, it's more likely than not that Asian currencies are going to remain weaker for longer than many people anticipate against the dollar. Interest rates, if you're looking for market interest rates to come down in this part of the world and give you a little bit of reprieve on your car loan or on your mortgage, it's not going to happen. What you should prepare for is higher for longer interest rates, so have the extra cash ready in case you have floating rate interest rate that you may have to pay more interest on your individual consumer-related loans. Sorry. So I'll stop there and for questions.
Okay, thank you, Doctor, for the insight. So looks like the panda bear is gonna be hanging around for quite a while.
Sorry, the panda bear, yeah.
Yeah. Okay, before Doctor, before we go to the questions, just now due to my eagerness to listen to you, I missed out the promotion slides for Indonesia and Thailand. So we will just run through the promotion slides for Indonesia and Thailand now. Wafi?
Okay, thank you, Alan, for the opportunity. Thank you, Dr. Sailesh, for the presentation. Very excited. Allow me to deliver the presentation in Bahasa Indonesia. Selamat siang, Bapak Ibu. Ya, jadi ada beberapa promosi dari Indonesia. Yang pertama dari RHB Sekuritas Indonesia. Nikmati promo Smart Fee, di mana Bapak Ibu bisa menikmati nilai fee transaksi jual beli saham serendah-rendahnya 0,08%, serta yang kedua adalah Smart Rate, yaitu memaksimalkan potensi transaksi dengan bunga margin ekonomi serendah-rendahnya adalah 0,025% per hari. Next slide on number 3, di nomor 3 kita punya Smart Point, di mana poin reward transaksi yang dihasilkan dari transaksi Bapak Ibu bisa ditukarkan menjadi saldo e-wallet, serta yang keempat adalah fitur Smart Analyzer. Dengan fitur Smart Analyzer bisa meningkatkan akurasi dalam menganalisa saham. Kita juga memiliki RHB Trade Smart Syariah, platform syariah online trading system yang sudah seamless, real time, quick, easy, and smart. Oke. Ya, kita juga memiliki partnership dengan Lebih, di mana dari Beli kita ada free RDN sebesar Rp100.000 setiap pembukaan di periode Juli 2023 sampai dengan Juli 2024. Ya, jika Bapak Ibu ada pertanyaan mengenai webinar siang hari ini, silakan tulis di kolom Q&A. More than happy untuk deliver ke Dr. Sailesh. Thank you, Alan. Go back to you.
Thank you, Wafi. Kunte?
Yes, Alan, thank you. สำหรับโปรโมชั่นของประเทศไทยนะครับ RHB ฟรีค่าคอม 0% นาน 60 วัน สูงสุด 10,000 บาท เมื่อซื้อหุ้นผ่านออนไลน์นะครับสำหรับลูกค้าใหม่ที่เปิดบัญชีหลักทรัพย์กับทาง RHB ตั้งแต่วันที่ 1 กรกฎาคมถึงวันที่ 30 กันยายน 2566 เท่านั้นนะครับเงื่อนไขเป็นไปตามที่บริษัทกำหนด Next slide please สำหรับโปรโมชั่นต่อไปเทรดได้ให้เลย Diamond Plus ค่าธรรมเนียมซื้อขายสูงสุด 40 บาท รับ 3 point ทุกประเภทบัญชี point สะสมประจำปี 2566 เริ่มตั้งแต่ 1 มีนาคม 2566 ถึงวันที่ 31 ตุลาคม ลูกค้าสามารถแลกซื้อกองทุนรวมกองทุนลดหย่อนภาษีหรือสินค้าสมนาคุณตามที่บริษัทกำหนดการตรวจสอบ point สะสมและ point คงเหลือลูกค้าสามารถตรวจสอบได้ทุกวันที่ 2 ของเดือนถัดไปด้วยตัวเองผ่านทางเว็บไซต์หรือผ่านเจ้าหน้าที่ผู้ดูแลบัญชีของท่านหรืออีเมลมาที่ th.support@isbgroup.com Next slide please สำหรับโปรโมชั่นสุดท้ายนะ DCA Smart Fund ลงทุนต่อเนื่องผ่านกองทุนรวมกับบริษัทหลักทรัพย์ RHB ลงทุนต่อเนื่อง 6 เดือนและมูลค่าสะสม 12,000 บาทขึ้นไปรับหน่วยกองทุน K-Cash เพิ่มอีก 0.2% ของเงินลงทุนอัตโนมัติหรือรับบัตรกำนันTesco Lotus ตั้งแต่วันที่ 15 มีนาถึง 30 ธันวาคม 2566 หากทุกท่านมีคำถามสามารถทิ้งมาในช่องแชทได้นะครับ Thank you, Alan. Back to you.
Okay, thank you, Kunte. Okay, let's move to the Q&A. Doctor, so let's start off with this first question. U.S. economy seems like it's so strong, which has even surprised the Fed, right? So if the Fed continue to raise the interest rate, do you agree that at one point it may jeopardize the retail sentiment in spending?
So we've looked at this quite closely, and I put up again, actually, can I share my screen again, Alan?
Yeah, sure, go ahead.
Let me do that so that I can explain a bit better. Right. So just to give you the full picture in terms of our forecast. So we, in fact, after this advanced estimate of second quarter GDP was released a month or so ago, we upgraded our forecast to 2%. Upgraded forecast to 2.5% for this year from 2%. The Fed by the year end, they have the projections at 2.1%. This year, and next year they're 1.5%, and next year we are at 2.2%. So the question is very, very good in terms of if the Fed goes higher. So we have that in our forecast, in fact, where we think that the Fed goes to 5.5 to 5.75% with the balance of risk that they may need to go to 5.75 to 6%. And our view on U.S. GDP growth is predicated on a strong consumer. Okay, that consumer resiliency will remain simply because the labor market effect will supersede the labor market will remain quite resilient. The consumer balance sheet and corporate balance sheet in the U.S. is going to remain fairly strong, and that consumers this time around, as opposed to heading into previous Fed hiking cycles, even the Fed hiking cycle of 2015 to 2018, is less leveraged to interest rate sensitive, loan products or other products where they have to pay interest rate, right? So hence, even with our above consensus forecast on inflation in the U.S. and above consensus forecast on the Fed, we're quite comfortable that the U.S. consumer will remain fairly strong. And that's the reason we have also been recommending not only being long U.S. equities, but beneath that, at a sector level, we like the U.S. banks to buy those on dips as well.
Okay, thanks, Doctor. Let's move on to the next question. If China continue to slow down or even go into a recession, will the U.S. Fed consider to loosen the monetary policy in your view? And in the past, we are also very much believe the U.S. and China should be growing together, right? What if number two economy goes into a recession? Any impact on the U.S. economy, or how does it affect the monetary policy of the U.S.?
Right. So first and foremost, a lot of what the U.S. does from a trade perspective, they're already delinking from China. Okay, that's point number one. The second point is that when you think about the relationship between US GDP and China GDP, it's not that clear cut. So if you look at the left-hand side chart, China GDP has been decelerating, but basically US GDP remains fairly constant around that 2% rate, right? So the linkages in terms of trade have come off. And so what that means is that in terms of the growth impact of China on the US consumer is going to be very, very limited. And China's US financial market has disentangled from the Chinese financial markets, particularly the equity market. A lot of what's going on in China's equity market is more domestically driven rather than externally driven. So which brings us then to the key point that the message is that, as I mentioned earlier, China is already in a recession. It's not like the recession isn't there, because from a actual perspective, Chinese economy will grow at 2.5% this year, and next year it'll grow around 3%. And 3% is just enough to feed the population and keep the social unrest down, which over the last couple of years as you can see from one chart that I'd like to show you, the number of protests has been going up on the right-hand side chart. So that's one thing that we track. How are the protests going in China to tell if a recession is there? Basically, the Chinese economy is already in recession, but U.S. no signs of essentially collapsing or into recession. And similarly, Singapore, Indonesia, South Korea, to name a few in Asia, are actually accelerating. So the dynamics of China, as it stands today, and our view of 4.5% GDP growth over the foreseeable future is not going to stop the Fed from hiking. It's not playing in their calculation. What is playing in their calculation literally is strong U.S. growth and inflation, core PC inflation remaining fairly elevated.
Okay, thanks, Doc. Okay, I move on to Indonesia. Wafi, you got any question for Doctor?
Yes, Alan, thank you. We have several questions here from the chat box Q&A. The first one, I guess this is another issue that coming early, because there is a higher worried regarding the China recession impact to Indonesia, because China is one of the biggest trading partner of Indonesia. Does it pose another downside risk to Indonesia, except from the currency you mentioned earlier, Doctor? And the second question is regarding the commodity prices. You mentioned the oil prices may break the 100 mark in the earlier couple of weeks ahead. Will it remain above 100 level, or the 100 level mark is only temporary and it will go south again?
Right. So that is a great question by your client on slide 14. You will see when we look at what is the ultimate destination of Indonesia's exports. It's true that you have a lot of trade going on with Indonesia, with China, right? Stuff gets shipped to China, all that business, right? That's the direction of trade. But the bottom line is, where do these goods ultimately end up? Because as you know, China is one big processing center and is one major part of the global vertical supply chain, right? Stuff goes into China, they process it, send it to other part of the world. But at the end of the day, where is the demand for Indonesia product coming from? So this is something that many people don't know or underappreciate. When you look at the relationship between Indonesia and US retail sales, this is from our econometric model estimate. All you need to know is that the largest contributor, which is of demand for Indonesia's exports, is the US consumer. The relationship between Indonesia and China retail sales, where you see this negative sign, basically negative 0.287, that doesn't mean anything because the statistical significance of that is not there. It doesn't mean anything. So the main drivers, in summary, of Indonesia's exports is the U.S. consumer. As long as one is positive on the U.S. consumer, we're okay on the Indonesia exports front. And of course, Indonesia's export-oriented sectors generate jobs and income like in any part of the world, right? That shouldn't be profoundly impacted as it affects consumer spending, which is a critical driver of GDP growth in Indonesia. In June, when we had come around Indonesia, we had told clients, right, that, or not told, not speaking at them, but mentioned to clients onshore that, the asset allocation that you have of overweight fixed income, market weight equities, and underweight cash, a little bit too conservative. I think we should shift, which is at the end of June. We mentioned that in our full report, along with my good colleague, Andrew Wijaya, sitting out here in Jakarta with Wafi, of going overweight equities, market rate fixed income, and underweight cash. And three main reasons why we went overweight equities in the Indonesian context, right? JCI target, if I remember, around 7,400, right, Wafi? That's our end year target. I don't think that's changed. We're doing very well. We're above JCI at around 7,400 currently. We're headed to a higher level. Three main reasons. Commodities up, Indonesian stock market up. Point number one, our commodities view followed our trip to Indonesia, in fact, right? Just to be internally consistent. You know what I mean? We need the commodity view to also trade Indonesia. We went bullish on commodities in the month of July, particularly on things like oil, food, you know, and some metals prices as well. So that's point number two. Point number three is that we're not that worried about the currency. You know, the currency is tracking a little bit higher than what we had anticipated coming into this month. Let me give you our currency forecast. Yeah, we're basically, 14.8. We're at the have eclipsed the upper end of the range, 14.8 to 15,300. Yeah, 14,500 to 15,000 looks a little bit high from what I can see now because of the overnight dynamics of the Fed, you know, being very quite hawkish. Maybe we trade in similar range, you know, maybe above 15,000, 15,500. That's the balance of risk assessment for the end of this year. And maybe next year we're a little bit higher level at the end of this, at the end of 2024, maybe closer to, from a balance of risk perspective, 14,000, 14,500. Nothing to write home about. So the currency story, very good, meaning looks okay, stable. You know, as I said, we're neutral on the currency. I just need a neutral currency view, right? And third, because Indonesian stock market had been underinvested by foreigners, that positioning has started to turn, but it's not fully turned in a way that will suggest that there's more room for foreigners to buy the Indonesian equity market. So that's kind of like the flows perspective. So bottom line, in a long-winded fashion, don't worry, be happy, Wafi, because the JCI is going to go to my esteemed colleagues' average target of 7,400 plus by the year end.
Okay, thank you, Doctor. And another question regarding the oil prices. Will it remain above 100 level for quite some time, or maybe 100 level is for temporarily before it going south again?
Right. So my concern is tilted more towards we're likely, from a balance of risk perspective, until the first half of next year, we're probably trading in terms of Brent oil, if our global recovery view remains is on target. Hopefully that happens. That the Saudis and Russians continue to restrain supply. We are more likely for the better part of the first half of next year, from a balance of risk perspective, at $100 to $110 per barrel, right? And so that's clearly positive for basically the Indonesian stock market. That's how I would think about it. Second half of next year, maybe we're back down to somewhere in the $80 to $100 per range. But oil is going to remain in this range. You know, we've been trading this range like $80 to $100 per barrel in that range, right, for the better part of this year, particularly the second half. So second half of next year, we're probably around there. And for the foreseeable future, we're going to be up there. The issue is that even if demand weakens, suppose that growth starts slowing into 2025, what will be the offset is supply side restraint. Because Saudi Arabia, the Saudis aren't doing well. Middle East is not doing well, right? The property market is, from a balance of risk perspective, going to collapse. Okay, Russia is not doing well in terms of economy. So what do they to support their economies? They have essentially just oil. So it's critical that they maintain this $80 to $100 per barrel range, where their economy, the financial market, has some chance of remaining stable. So there's a geopolitical angle to forecasting oil prices.
Okay, thank you, Doctor. Very clear. I think that's all for me for now. Back to you, Alan.
Thank you, Wafi. Kunte, Thailand, any question for Doctor?
Yes, thank you, Doctor, for the presentation. So my question is quite straightforward for the China. So when will you see the recovery for the China?
For China, you mean? Sorry?
Yeah, for China, yes, for China.
We don't really see any signs of recovery over the next 12 months, right? The dynamics of China are the following, which I didn't go into any level of detail for this call, right? So the problem in China, there's a structural problem first. There's a structural issue in the first place, right? Is that the monetary policy and fiscal policy transmission mechanism is weak. So slide number 27, left-hand side chart, look at basically the change in deposits, right? We should be seeing acceleration in deposits, but that's not the case, right? As the country loosens fiscal and monetary policy, it's not happening, right? And that is due to the idea that people are afraid of putting their money in the banks, right? Because the Chinese financial markets are so complicated. The next big risk on the horizon, besides property sector, is the banks, right? So what is causing the problem in China is a domestic crisis of confidence, both among consumer and businesses to put their money in banks, right? Because the banks are linked to wealth management products, to the bond market, to real estate sector, to many right esoteric products as shown on the right-hand side chart. And the reason why we have basically problems of cutting, in terms of monetary policy loosening and fiscal policy loosening, transmitting into strong M2 growth or recovery in deposits, and essentially then the economy recovering, is the China debt to GDP ratio, particularly non-financial corporate sector debt. The green line, right-hand side, is close to 160% of GDP today versus in 2008, it was roughly around 95% of GDP. Okay, so the high debt is basically leading to the plumbing being jacked. So there's a structural problem at hand. And the other issue is that the Chinese policymakers, from a structural perspective, want this income distribution to improve. So slide 18, left-hand side chart, the Gini coefficient, which is just a higher number, is higher income disparities among the population. So the Gini coefficient, or red line, had peaked back in the financial crisis, roughly around 44, and then now is back down to around 39. So they want that trend to continue, so that when you look at right-hand side chart, that 2020, the protests went down after a lot of clampdowns. They don't want an accelerating trend in terms of social restraint. So what that means is that the opportunities for Chinese economy to grow their business, because you have the socialist policy in hand, right? So for example, people who are operating, rich people who are operating good businesses are not allowed to operate those businesses because the Chinese government wants them to essentially engage in activities which are more friendly to the lower to middle class. And the situation doesn't improve on the external front as well. The geopolitical angle from the Western world, where we see that the external pressures from the Western alliance on China as it relates to trade, investment, Straits of Taiwan will only intensify. You put all the external factors, domestic policy factors together, how can Chinese economy recover? It can't. So that's what we've been saying all along since December 15, 2022, in our 2023 outlook: sell China. There's no point in taking that risk and invest your money in the US, invest it in India. India cannot absorb all the flows from China. If you sell China, India will be able to absorb. To be very clear, you have to diversify. US, India, Japan, Korea, Indonesia should be in your portfolio. That's how we think about it. So I don't have any good news for you for people who remain invested in China's equity market, unfortunately.
So, and the second question is, among those beneficial countries like Southeast Asia, India, do you have any a specific sector for the recommendation?
So I would say, from the balance of risk perspective, like our top, like in Southeast Asia, Indonesia is our top pick. We like the consumer, we like the banks, we like the infrastructure story. In India, from a balance of risk perspective, I think things like IT is a good place to be. Essentially, some of the industrial sector, capital goods producers from a sector perspective, and basically the consumer, right? That's how we would think about it from a sector perspective.
Okay, and the last question about the US. Do you think there will be a recession on the housing or maybe property in the US?
No. In fact, I don't have the charts on me here, but you will see it in our weekly report, Global Cross Asset Flows Tracker report, which will be published today. You will see that the housing market is in a recovery phase now. Okay, it's been accelerating for the last 2 months, and we expect this recovery in the housing sector, which supports our above consensus view on US GDP to be supported by recovery in housing sector.
Okay, that's all. That's our question from Thailand. Thank you, Doctor. Back to you, Alan. Thank you.
Okay, thank you, Kunte. Okay, the next question, there's a question from the chat from CK Hui. The bullishness of US equities, he's asking whether it's only in certain companies such as the Magnificent Seven. I think he's referring to all these Apple, Microsoft, the 7 companies, or is it in every sectors?
Right. So we have been saying, last couple of months that the sector outperformance is going to widen. It's not just basically the Magnificent Seven, right? And where we see that broadening out, we have been bulls on U.S. banks when they were selling off hard in April to buy the U.S. banks on any dips, right? So I think besides tech, which is likely to continue to run because we think the NASDAQ will basically probably give you another 10% from here, right? That the banks are our next pick. That's what's going to be, kind of in that widening of the outperformance. The banks will be the next sector. So focus on the banks.
Okay, thanks, Doctor. All right, let's move on to the next question. The Japanese yen seems to be on the weak side, and the rate has been close to zero. So it's something like a risk-free carry trade, right? So what if the Bank of Japan decide to be hawkish and to guide a strengthened yen or tighter policy? Will that cause a stir in the global market?
Yeah, where it will cause a stir, right, is in bond yields. Okay, so suppose the Bank of Japan starts thinking about further in terms of tightening of policy. So the yield curve control in terms of the rate moves up, right, which we saw about a month or so ago, right? Cause short-term turbulence, but not a sustained turbulence. But if it's something that is more sustained and larger increase in the rate in terms of yield curve control, the turbulence will come in bond markets, global bond markets, particularly in the developed markets. That's how I would see it, and that will cause some short-term disruption in global equity markets as well. And dollar yen then trades closer back down to around 140 to 145, depending on the magnitude of the hawkishness of the Bank of Japan. Our central view remains unchanged. We don't think that the Bank of Japan is going to embark on any significant tightening of monetary policy via yield curve control or interest rate policy. And the yen remains weak at around $1 yen at 145, 150 for at least this quarter, and then basically next quarter as well. And we remain in those ranges in the first half of the year. And what that means then is our long Japan idea via the MSCI Japan, which has given you around 13.7% return, including dividends this year, is likely to give you higher returns as we traverse the next 3 to 6 months. That's why we like Japan, also because of a continued weak yen.
Okay, thanks. Okay, there's a question from Mr. Liu. He's asking, if I'm holding ringgit, is it a good time to buy Aussie dollar?
So I'm not going to comment too much on Aussie dollar, right? Because I'm not that familiar with that cross. But what I can comment is on essentially dollars, right? And which you can then extrapolate to Aussie as well. Okay. The bottom line is we've been bears on ringgit for quite some time. View is materializing by the end of this quarter. If you look at our forecast on slide number 10, we're at 465, 475. We will be essentially, in about 9 days' time, on September 29 is the last trading day, next Friday, we'll be at the upper end of that range. So mid of that range, and we're going to follow suit to 470, 480. And the ringgit by the end of next year is still going to be at very high level, 450, 470. With the balance of risk that we go to much higher levels beyond the 470 to 480 in our assessment. Our econometric model is suggesting that by year end, if we don't get significant intervention by the Bank Negara or improvements in fiscal policy, that it could go as high as 488. In plain English, for those of you who hold ringgit and have needs for foreign currency, basically sell. We've been telling our clients to sell ringgit on any rally. When the ringgit was trading at 450 on July 31st, I remember, it had collapsed, right? It had been trading 465 and then collapsed way down to 450. At that point of time, we had also said, sell your ringgit now. Don't take the consensus view. Some of you listen to some of the other brokers in the market. They're thinking 420, 430. Those guys would have lost you money. And even the traders in this country have been losing money on the short dollar ringgit trade. The market had been anticipating that dollar ringgit would go down by the year end rather than up. That's not happening. Bottom line, our current consensus view is working. So sell ringgit on any rally if you have exposure to foreign currency, because this currency is on a trend weakening path. It's just not like over the next 3 to 6 months against every single currency against Southeast Asia, like Singapore dollar. So a lot of you have exposure to Singapore, travel or business or friends. It's going to continue to depreciate against regional currencies over the next couple of years.
Okay, thanks, Doctor. Doesn't sound too good for the ringgit, right?
Not at all. And the challenge now, Alan and everybody on this call, is if you have exposure to the domestic stock market, it's bad. So the trading volumes, a lot of people, right, have been the consensus view is, once elections are over, all uncertainty is going to be over. The incumbent comes, retains its positions in the majority of the states. It's all good. The stock market going to rally. It doesn't happen. Basically, stock market has been, weakening since the elections are over, which is where our currency view came in. We thought basically election result doesn't mean anything. Bottom line, right? The situation here in Malaysia hasn't changed. The Malaysia Madani program, the midterm review of the 12th Malaysia plan really doesn't do anything as far as the economy goes, or the performance of the stock market, performance of the currency. And now what we're seeing is foreign investors are selling the bond market over here. That's why for some time now, our asset allocation in Malaysia, suppose you have to only be invested in Malaysia, has been to be overweight fixed income, market weight cash, and underweight equities, if you only can invest in Malaysia. Okay?
Okay, thank you, Doctor. Okay, coming back to the local front, Malaysia, there's a question on what sort of additional taxes we can expect the Malaysian government to introduce in the coming budget.
I'll give you a one-liner. Nothing much. Okay, so we're not expecting what we need. Okay, in Malaysia, what we needed to hear from the government literally was the sequencing of reforms, right? And that's at the top of those sequencing of reform. What do you do first? Like what Indonesia and Philippines had done in the early 2000s to get out of the mess. I'm sure Berlian will remember the early 2000s. Indonesia was in a mess. It's not like today, right? Currency was depreciating. People really didn't like the financial market, right? The first thing, do the fiscal reforms. Second is essentially do the labor market reform such that it's easier to restructure labor force, basically easier to fire people. Okay, and third is essentially focus on three sectors of growth that you want to promote. We haven't seen any of that from the government. right? It's all over the place. It's like a collage. I call it a collage. There's so many things, but nothing really fixated on the sequence of reform. Now, to address your question directly, if the fiscal reforms are at the top of the agenda as to what you should do in terms of policy reform to get your economy, get your financial markets outperforming in this part of the world, what do we need here, which they won't do, is basically any significant tax reform, such as reintroduction of VAT, right? GST, sorry, call it. Now, there's no GST coming back. There's no basically a significant reduction of subsidies coming. There's no basically reduction of expenditures coming, like emoluments, which are basically civil service, administrative expenditures. No significant decline or cuts in development expenditure. No significant cut in subsidies. Right? They got nothing. So we don't expect any of these major policy reforms to come through in the 2024 budget. They're talking about capital gains tax. What we've been talking forever, but that's not going to give you much revenues anyway. So the bottom line is that the balance of risk is that Malaysia sovereign rating gets downgraded next year, right? The currency is telling you that. The stock market is telling you that. The currency and stock market is telling you that the market doesn't believe in any of the things that the government has announced so far, whether it's Malaysia Madani, whether it's a midterm review of a 12th Malaysia plan, the energy transition paper, nothing. So at the end of the day, always look at how the stock and currency market is the summary of your country and market. If your currency is not doing well, it clearly means that the market doesn't believe you in terms of the future policy of any country that you are monitoring closely. So not so good news, Alan, unfortunately.
Okay, thanks, Dr. I was about to follow up with the question, asking you your view on the National Energy Transition Roadmap. I believe you have already addressed that part, which together with the new industrial master plan, whether it's going to help the GDP and encourage private and even the sectors, public sectors investment. Yeah.
Right. So those are all good on paper. But in terms of actual details and execution, we don't know anything yet. So, for example, the government has a plan, thinks that the trend growth of this economy, trend GDP growth of this country, because of all these policies, reform policy they've announced, is going to 6 to 7%. I'd be very happy if that happened, because that would make me less worried on the debt to GDP ratio, which is around 88% currently, right? So our view is that trend GDP in this country is going to remain at 4 to 5%, which has been since the last 10, 15 years anyway. So we're not convinced that all these policies that you just mentioned, Alan, is going to raise the trend GDP growth, bring debt to GDP down, improve growth, stabilize the currency, stabilize the stock market. We don't see that happening, at least this year and next year. That's the problem right now. So in summary, Alan, using your own language, not my language, right? NATO, not NATO, not North Atlantic Treaty Organization, it's NATO. No action, talk only. That's the summary of the policymaker.
Okay, NATO. All right. Okay, let's look at this. There's this question on China. Let's go back to China. What China needs to do to regain the confidence in the economy?
So what they should have done, which they haven't done, again, let me mention again, the 3 reforms in any emerging market that need to be done. At the top of the list is fiscal reforms, right? Where are those fiscal reforms, Alan? When you see, let me show you where we are in the fiscal position. Left-hand side chart, what have they done? Are you able to see the charts? No.
No, not yet.
Let me show you again so that it's clear. Let me be very clear to you. If I see this debt to GDP ratio, particularly non-financial corporate sector debt to GDP green line turning around, I'm bullish, right? And basically by that time, hopefully all the China bulls have already left and become China bears, right? Then I'm basically in the market out there, right? But we're not seeing this. And the reason why, and it's not really something that is a quick fix, because I remember back in the day, years and years ago, what the problem in terms of China is that much of the debt sits at the municipality level. You know, it's not like at the state level. So, Alan, as opposed to here in Malaysia, so here's some good news for you, Alan, and your viewers. In Malaysia, most of it is national government, federal government. Okay? So that's cool. We can see where it is. We can see, you know, to a large extent, much better than in China. So here, it is a quick fix. So in Malaysia, it's a quick fix, but basically it's a political issue. Okay, that it's hard for them to do those big reforms. In China, even if they want to do it, they can't, because they don't know where precisely the debt is residing. And they haven't started in that process of the statistics, at least in the official domain. So the National Audit Office should have already released over the last couple of years, every single year, the statistics, detailed statistics of where this, like the green line, non-financial corporate sector debt. This is a meaningless number. You know what I mean, right? At the macro level, okay, fine, I can see the trend, but which companies is the debt sitting in non-financial corporate sector? Where exactly is it? Which companies, which geography, how much is it? How much is the tenure, the duration? We don't know. Not that, you know, that the Chinese officials know as well. So that's what I'm trying to say, is there's a massive structural story which is retarding or restraining the cycle from improving, both in terms of the market and economy. So I'm just saying, right, there's better places to invest. That's all I'm saying. You know, there'll always be stocks which will do very well, give you 20% in China, right? That's from a trading perspective. But from a basically strategic perspective, you're not going to be able to catch those trades, and it's risky anyway, right? So conclusion is the quick fix, they don't have a quick fix to their problem because they don't know what's going on in terms of their debt exposure.
Okay. So second part to the question, they are asking, they are saying that China has become the top exporter for cars in the world, right? So why is it not reflected in the share market, or even because the economy is still rather gloomy, right? So what's the reason behind?
Right. I mean, that's a fantastic question, if I may. So here we are. So you're right. MSCI China is down by 9%, right, on this chart. The reason is because the majority of the indices, and remember that there are many indices, right? There's the China A-share. There's basically, the HSCI, the Hang Seng related to China. We have the MSCI China, which is what we use from an international comparison perspective. Is because the majority of the index, that's what I'm trying to tell you. It's not that there's no stocks you can buy in China. That's not my point. There will always be stocks which do well in any country, even in a bear market, right? Is that the indices are dominated mainly by the banks and property sector, okay? And then follow through with some of the tech names. That's how it works, right? So you have to look under the hood. So as you know, some of the tech names in China related to things like EV have done well. To be clear, right? So your question, that they are the biggest exporter of cars. Well, part of the cars is basically electronics related products. They've done okay, not too bad. Okay, not great, not bad. So the banks and property is the reason why the indexes remain in negative territory.
Okay, thanks, Doctor. Okay, moving on a bit on the commodities. Doctor, you've been right on the oil prices, which has surged recently. Will a higher oil price encourage the US to have more rate hikes to combat the inflation?
So this is the oil price where we have been fortunate to have gotten that correct in terms of the path, meaning up since July. We've mentioned that, right? That we're bullish on commodities in our weekly report published in July. Yes. So our Fed view, our controversial counter consensus view on the Fed. If you look at our forecast, it's not like we have changed the Fed forecast recently. At 5.5 to 5.75% peak this year, we now, with the balance of risk that they could go to 5.75 to 6% peak. Yeah, partially it's due to the higher oil prices. Yes, that's correct.
Okay, thanks, Doctor. All right. Okay, maybe we take the last question, Doctor.
Sure.
Yeah. There's a statement here that China has managed to roll out the latest handphone by Huawei. Any chance that this is going to support? This is able to support the economy?
Probably not. All right, because the major source of keeping in mind. So let me show you. Go to my charts again. Some things I didn't show you, just in the interest of time. Is if you look at the right hand side, the main driver of growth in China is consumer spending. Okay, and consumer spending, in summary, where does the income come from? It comes from industrial sector and essentially property sector. Property sector is still fairly weak. If I show you, is it there somewhere? Yeah, I have that somewhere. But in the interest of time, the bottom line is that the property sector and export sector are likely to remain fairly soft. Chinese consumer weak, and so the Huawei thing, in terms of new phones, will have a marginal impact on growth. Is the key conclusion.
Okay. Before we end, I think Indonesia got one question. Berlian, you got anything to ask?
Yes, thank you, Alan. Thank you, Doctor, for the explanation. The last question will be about the U.S. market, of course, because you're so bullish on U.S. market. Is there any particular sector that you are looking at, Doctor?
Yeah, so we continue to... Right, yeah. So Berlian, as I mentioned earlier, we continue to like tech, right? We like the NASDAQ. We think maybe around 10% upside from current levels. So tech is one sector, and the other sector is banks. So we have had the trade on to buy the U.S. banks since April, right? And that has worked quite nicely. You know, it's the momentum. I won't say it's as exponential as tech, but it's basically steady upsurge in banking sector stocks. You know, since the month of April, where we had the long U.S. banks trade on. So I would start with that. If you have to invest in the U.S., yes, have the tech exposure, but follow through with the banks. That's what we can see most visibly right now.
Well done, Doctor. Thank you.
Okay.
Back to you, Alan.
Thank you, Berlian. Okay, so thank you, Doctor, for addressing all the questions that we have the time for today. I could have keep on talking and asking you more questions, but we are just running out of time. So as we come to an end of our webinar, I want to express my gratitude to all of you for joining us today from near and far. Your participation and engagement have made this event truly special. Remember, the world of finance and economics is ever evolving, right? And staying informed is the key to success. So we encourage you to continue your engagement with RHB and stay updated with these important topics through all these webinars. So on behalf of RHB Investment Bank, we wish you all a successful and prosperous investment journey anywhere in the region. So thank you again and have a wonderful day ahead. Thanks.
Thank you.